Hey, this is John Bartlet from Brentwood Growth. Thank you for taking a few minutes. I wanted to talk about something today that I think gets overlooked too much early in the process. Um, we've spent a lot of time talking about how you determine what the value of the company is and how buyers will look at the company from a valuation standpoint. We've talked about cash flow, we've talked about free cash flow. We talked about multiples, what multiples are and how multiples are calculated and what multiple ranges are based on the size of the company and the revenue mix of the company and the infrastructure and what the owner dependency is, and how those multiples go up as companies get larger and there's more infrastructure in place and there's less owner dependency and less risk, and buyers will pay higher multiples. And so, valuation of the business, it's the free cash flow times the multiple that a buyer is willing to pay for the business, and all that makes sense. Um, a lot of times, though, when we talk about what businesses, where we think the market's going to price them, or what a buyer's willing to pay for the business. Whether it's $2 million or $10 million or $20 million, whatever the number is, whether the multiple is 4 times, 6 times, 8 times, 10 times, whatever the multiple is. Everyone, that's sort of the headline number that everyone gets attached to. What we don't spend enough time talking about is what the components of that valuation is, and how those components will get paid out to determining what that ultimate value is. And I want to spend a little bit of time talking about that. So, whatever a buyer's going to pay for the business is what a buyer's going to pay for the business. But there are different ways that the transaction structure can be structured. In the four main pieces, there can be a cash piece, there can be a seller note piece, there can be what's called an earnout piece, and there can be a rollover equity piece. And I want to spend a little bit of time talking about each of those. Okay, cash is easy. It's the amount of cash that the buyer is going to bring to the closing table, and it's what gets wired into the account, and it's what the seller walks away with the day after close. And that cash can be 100% of the sale price. It can be 80% of the sale price. It can be 50% of the sale price. It can be lower than 50% of the sale price. And so the cash piece can vary based upon what the buyer is willing to do and what the seller's willing to take. And so, the cash piece can vary based upon the transaction structure and the transaction terms. Second piece can be a note that the seller takes back. And so it's not cash. It's a unsecured note. The seller takes that note back. There's a specific period of time that note's going to be paid out over. It can be an interest-only note. It can be a fully amortizing note. The term of the note can be 2 years. The term of the note can be 5 years. The term of the note can be 10 years. The interest rate's going to vary. But the seller is going to take that back as a note payable to them. They're going to get interest off that note. There might be amortization, and they get principal off that note. And so it's going to be a portion of the sale proceeds that's not paid in cash. And sometimes we see seller notes. A lot of times there's not a seller note in the transaction. Sometimes there can be a seller note that's 10%, 20% of the transaction value. And so that's the second piece that needs to be considered. The third piece that needs to be considered is an earnout piece. And what an earnout means is The buyer's not going to pay you that piece in cash. Assuming that the business performs at certain levels, then the buyer's going to pay additional proceeds at the end of the first year, at the end of the second year. Usually the earnout can be a 2-year earnout, but it's a cash bonus that's paid assuming that the business hits certain performance thresholds that everyone agrees to on the front end. That's going to be paid out in cash. A lot of times we'll see this on businesses that are growing very, very quickly. You've seen significant revenue growth and significant profit growth over a 2 or 3 year period. When you average what the profit number is over the 3-year period, it might be a certain lower number, because if you go 2 years back or last year or even further back, the business was operating at a lower level, but there's been significant growth. And so they'll say, okay, we're going to pay you an average over the last 3 years in cash, but assuming that the business performs at the level that it performed at this past year, we'll pay that increased performance in the form of a bonus that we'll pay at the end of the first year, or maybe a bonus that we'll pay at the end of the first year and the second year. And it's really fair. They're paying you in cash on what an average 3-year historical performance of the business has been, but they're giving you the ability to earn additional cash proceeds, assuming that the threshold level that the business has hit continues to be maintained over the next year, over the next 2 years. And so it is a bonus that's called an earnout that will be paid out assuming that the business continues to perform at certain agreed upon threshold levels. And this earnout sometimes can be in the 10 to 20% of the sale price of a business. The final piece is rollover equity. And we often see this when a business is being sold to a private equity firm that's doing a roll-up consolidation in that particular industry segment. And so what the private equity firm is doing is they're buying this business along with 10 other businesses, 20 other businesses, 30 other businesses, and they're rolling these up into a holding company. And then they expect to sell that holding company at the end of 3 years, 5 years, 7 years, different terms based upon when you come in. They're expecting to sell the holding company that's now comprised of these 20 to 30 different companies at a much higher value because of the multiple expansion that has been that's been able to be achieved through the aggregation that's now part of this holding company. And so what rollover equity does is it allows the seller to not sell 100% of the business, but sell maybe 80% of the business, and then continue to own 20% of the business, continue to stay involved in the business over that 3, 5, 7-year period. And then when their business sells as part of the holding company, when that sale takes place, their equity that they have kept in the business, they get paid out in that equity based upon what the increased valuation is. And it's a way for them to sell a piece of the business, pull some chips off the table, to continue to stay in the business, help grow the business, and then when the holding company sells, they get to take advantage of the increased appreciation that their business has achieved, and sorry about that, and sort of get a second bite of the apple, so to speak. It's a way to sort of have their cake and eat it too. That can make sense for certain sellers that are willing to stay involved in the business. And so those are the 4 main points that are sort of explained in a greater detail: the cash piece, the seller piece, the earnout piece, and the rollover equity piece. Here's a quick example that I wanted to review that's a similar structure of a deal that we recently closed. It was a business that sold for 14 million. And so that was sort of the headline number that everybody talked about. The way that was paid out, it was 70% of the 14 was paid out in cash. So it was about $10 million that was paid in cash. There was an earnout of $2 million that was paid out over this first year and the second year of $1 million each, assuming that the business hit certain very achievable revenue numbers. And then the seller maintained $2 million of equity, which is about 15% of the business that he continued to own. He owned that in rollover equity, and then based upon what the growth appreciation assumptions that everyone had, based upon what that rollover equity would be worth in 5 years, everyone very conservatively estimated that $2 million would be worth $8 million at the end of 5 years. And so when you add everything together, it was the $10 million in cash, it was the $2 million of the earnout. There was $2 million of rollover equity that had the potential to appreciate to at least $8 million of value. And so when you look at what the total transaction value that the seller was able to walk away with over a 5-year period, it could be close to $20 million or maybe more. And we just use this as an example to show you how different deal structures can be made in very practical, real world examples. So I hope this has been helpful. Again, the point of this is for you to begin to understand, as you're thinking through the value of the business, what the different components of that transaction structure could be: the cash piece, the seller note piece, the earnout piece, and the rollover equity piece, and what might or might not be appealing to you or appropriate to you based on what your individual preferences and situations are. Hope this has been helpful. If you have any questions, please let us know. And again, this is John Bartlett with Brentwood Growth. Have a good day.